All right, we are now live on the TikTok. What's going on, guys? What's going on? How you feeling today?
Good. How about nice?
It's a beautiful Sunday. Today we're going to be talking about risk tolerance and goals. Let me send out the live invite first on Twitter and share it on Facebook. It's funny you can't share the live. I tried to share before, but I don't know why it didn't let me share it. Usually it does. Bow, bow, bow. And we are going to get started here in a second. And I'm going to do it on Facebook and then we'll get started. Got some people joining the TikTok. What's going on, y'all? Welcome to this session. Hope everybody's having a great weekend so far. My name is Michael Clark. I am owner of Culture Shock Investments, and I'm going to be giving you a presentation today. All right. We have the presentation. I know you could turn your phone sideways for landscape. It's probably best to do that for the slideshows so you get the full screen and you're not getting like half the screen. So I made sure I put this broadcast in both formats so you can hold portrait if you want, and you should be able to see a good amount of the slides, but some of them may be too long for you to see portrait. So turn your phone sideways for the landscape mode and get ready to take some notes if you're a beginner for sure in the stock market. Today, we're going to continue on to section 2. We just wrapped up section 1. We did the review last class of section 1. And if you missed that, make sure you go back. I posted some of those videos on the YouTube channel, the Culture Shock Investments YouTube channel. And they're available in the Discord as well. I'm going to make sure I post them up in there as well. But today we're going on to risk tolerance and setting goals. We pretty much went over the basics of the stock market, what the stock market is, what the major indexes are, how to understand when you're reading the stock chart, the basics of the ask price and bid price, things like that. I went over those basics with you already. And now, before you start opening your investment account and brokerage account, start investing, you have to understand your risk tolerance. Risk tolerance is key when investing. It's like the number one thing you have to consider whenever you're making investments. You got to consider your risk tolerance. If you don't have understanding of what your risk tolerance is, you're going to end up getting killed in the market. All right, you're going to go in there maybe a little overconfident and ending up being over leveraged or over risked in certain areas and trying out certain markets like options and futures way before you're ready. All right, I know it looks fun. I know you see people posting the profits and people making all this money, but trust me, take your time. Stock market's not going anywhere. Make sure you are doing this in a way that's not going to blow your account consistently, and you want to scale yourself into the market. You don't want to jump in head first. Some people do it, and you're going to bump your head a lot if you do it that way, and you will learn. But if you have the capital to do it, or if you're willing to keep, risking all that capital and losing it, then you could go ahead and go about it that way. Hold on one second. I thought this thing was plugged in. Battery got unplugged. Just make sure you share the space. Send it out. We're going to drop some good gems and jewels today, especially for all my beginners. This is a crucial class. I'm going to break down some mathematics for you and pretty much explain how you should be looking at the stock market if you are in certain age ranges, because age makes a big difference about your risk tolerance. And what is risk tolerance? So let's start with that. Risk tolerance is the amount of loss you are willing or you can tolerate or withstand in an investment. All right. So if you lose all your money in this particular investment, will it make or break you? If it will break you, then that risk is too high for you. You don't want to be in something that if you lost or took a complete loss or 80% loss, that it will break you. Or by the time it hits your stop loss, it's going to be so devastating that it's going to break your account. All right, so that's risk tolerance as I describe it. So factors that affect risk tolerance: age. Like I said, the younger you are, the more risky you can be. You are able to recover more and able to bounce back fast over more time than someone who is older. Someone who's older, closer to retirement, they can't be as risky with things like crypto and altcoins and NFTs and any of those type of investments, because if they take a heavy loss, it's hard for them to recuperate that before their retirement age, and they're going to end up working until they're 90 years old. All right. And of course, income is going to matter. Income, the more disposable income you have, is going to help increase your risk tolerance. So the more income you have coming in, of course, that increases the amount of risk you could take with certain investments, and it's going to affect your capital different than someone who's making $30,000 a year. If you're making $300,000 a year and you're investing $3,000 and they're investing $3,000, okay? So your risk tolerance is much different depending on your income. And like I said, time horizon. The longer you have for investing, for riding out market volatility where you don't need to take out that money immediately for bills or to pay off anything, the more risk tolerance you have, okay? And then the most important factor is your personality. This is one that people tend to overlook. People tend to overlook their personality because they think that if they have the income, they're the right age, they feel like they have the right time horizon for the investment. They underestimate their personality and how they're going to react when the market starts getting real volatile, or you have your president come on TV and say something about tariffs, and then the stocks plummet and you see your investments go down 20-30%. At that point, your personality is going to start to show, and it's going to reveal really who you are and how high your risk tolerance really is. Because at that moment, you can have the age, the income, to dollar cost average into that investment, but you may be so frustrated with what you see going on and what you're hearing on TV with the back and forth and the news and the unpredictability that it may affect your investment strategy and may make you go off course. And then you may start doing things that are kind of off the rails and take you into a risk category that you don't belong in. All right. So, and then of course, experience. The more time in the market, the more you understand the importance of risk tolerance, and the more you have a gauge on your risk tolerance. All right, so let's go over some risk profiles. Hello, everybody in the TikTok. What's going on? What's going on? Thank you for joining. Welcome, welcome, welcome. We're going into risk profiles here. We have a conservative risk profile. That's going to be someone who preserves capital, who's looking to get into things like bonds, dividend stocks. They're looking for cash equivalents. Those are things that would be like commodities, I would say, like gold, silver, things that don't really fluctuate too much in their value. They're steady with their growth, and they're not too crazy with the dips and the losses when they do happen. All right. Then you have the moderate risk profile. That's going to be a balanced approach to growth stocks. So you may have some NVIDIA, may have some Apple in your profile, but you're also going to have bonds in your portfolio as well. You're going to have a lot of big blue chip companies, like maybe it's actually even hard to say, like McDonald's and certain things like that. But McDonald's has been pretty stable and is pretty steady of a company recently. And maybe some more banking stocks that are more steady, and dividend paying stocks, like it says. And aggressive. If you're aggressive, these are people who are usually younger, in their early 20s to 30s. You could be more aggressive in your investment strategy. You could go ahead and you could seek and accept volatility because it comes with high growth potential. All right, you got potential for big returns when you're investing in Bitcoin in 2015 if you're only 20 years old, and you have big returns on that now. Now you're 30 years old, that was 10 years ago. Your risk profile may change now, but back then you had a different risk profile. You were able to take that risk, and it paid off for you. At certain points, you went through certain dips and valleys, but ultimately, it ended up paying off for you. All right, and then those will also be like small cap stocks. So things that you find in the Russell 2000. We talked about that ETF in the last lesson. So make sure you run that back. And that's why it's important to be here. If you're not sure of what those ETFs are, I will post those lessons for you to catch up. But make sure you are staying on top and taking your notes, because you want to know and be able to keep up with the lingo as these lessons go on. All right. So, setting your investment goals. This is an important part that a lot of people don't do when they get into investment. Is more so like, I just want to get in, I just want to be making money every month, right? That's more so the goal I hear a lot when people first get into investing. They're just looking for flipping their money, essentially. They're not looking for long-term investment growth. They're more so like, I want to be able to put my money in the market this month and take out double my money next month or within 2 months. But a lot of the times, if that's your goal, then okay, you're going to have a certain kind of strategy that's catered to you. You're going to have a high risk reward profile. So if you're looking to double your money, that's going to require you to take a lot of risk in options and high leverage positions and things like that, which it can be done. It's not impossible, because I'm not going to sit here and act like it's impossible. But you got to understand what your goals are. If that's not your goal, and you know you don't want to risk losing that kind of money that quickly, then you may want to alter that goal from doubling your money in 2 months to extending that to maybe 2 years, okay? So why goals matter? We all know why goals matter. They give you a purpose and a destination in what you're doing. You want to be able to know, all right, I'm getting into the stock market, I'm starting to invest, and I'm doing it for this purpose. I'm not doing it for this purpose or this purpose. So when you're in your strategy, you don't tend to stray. And you could go back to your goals and see what you want to do, and it'll help realign you and help realign your strategy if you started to stray. All right? It's going to help you determine how much you want to invest on a monthly basis, for how long, and at what risk level. Okay? And then it's going to help you determine your common investment goals. A lot of people have common investment goals. You'll hear these terms a lot. So you'll hear emergency fund. I need to save an emergency fund for a rainy day, just in case you get fired or you fall behind on bills. You want to have something that is accessible and quick for you to get to, all right? Something that is safe, not at risk. You don't want this in any kind of risky investment. You want to have this in a safe, quickly accessible place, okay? Then you have your short-term goal money. That's the money you're putting into some kind of investment for 1 to 3 years. So once you get out of emergency mode, once you get out of survival mode, because this is what investment helps you break out of. Investing helps you start to break out of that survival mindset. A lot of people out here, we're in survival mindsets. And that doesn't mean you have low capital. There's some people out here with a lot of money, but they're still in survival mode. You understand? Because their bills are meeting their capital, and they're at a stage where they're just making their bills every month, even though they're making a lot of money. So you want to get out of survival mode, and investing helps you do that on any level of income, from low income to people making millions of dollars. Okay, you gotta invest. So your short-term goals, after you get out of survival mode, you have your emergency fund. That should bring you a little peace of mind and comfort, where it's like, okay, I feel comfortable putting money now in the stock market or starting to buy some Bitcoin, something like that. Once you have that emergency fund saved, and that money is going to go to your short-term goals. So that's going to be for things that you want to invest for 1 to 3 years for, whether that be you now saving up or investing for you to get a house, whether you need to level up and get a car in order for you to get back and forth to work and not be on public transportation. Whatever that goal is, because like I said, investing is not only for large capital. Once you have an emergency fund saved, you look at what you're surviving and living off of now. That emergency fund is there to give you that cushion, and now you want to take that little bit of capital that you used to help build that emergency fund to build this portfolio up, this short-term goal portfolio, all right? And then you have people who have medium-term goals, people who want to do down payments, weddings, start a business, and have a mix of stock and bonds, okay? Then you have long-term goals, 10 plus year, people who are looking for retirement goals, college funds for their kids, and looking to have wealth building strategies working for them in the meantime. So they'll mostly have stocks and high growth assets like property, some commodities that are growing at a good rate. These are people that are find different avenues to invest, whether that be certain bonds, because there are certain good growth, high growth bonds out there. They come with a little more risk, but they have good returns on them that you could buy bonds in other countries other than the United States. So, to frame this all out, I got something I call smart. You want to be smart with your money. So, let me get my water real quick here. Hold on. SMART, smart. Alright, I'm back. Make sure y'all hit the like button. Make sure you share. We ain't here dropping gems. We ain't here dropping knowledge for the community. Free gems, free knowledge. I do paid consultation with my company, Culture Shock Investments, but I love coming and giving back to the community, giving out free gems and free knowledge. So make sure you like the space, share it, so we could build up the community and get this knowledge out to more people, so more of us can invest wisely and we could grow more wealth in the black community and start to expand our ownership, because that's the main key of all of this, right, is expanding ownership. Let's keep it moving. So SMART stands for specific. You want to be specific. What do you want to achieve? What is your goal? Like we were just talking about, what's your goal? What goals do you have set? Then you want to be measurable. How much money do you need? All right. Do you have that amount of money now? Do you need to save up for this amount of money? How long is it going to take you to save up for this amount of money? Okay. And that's when it comes to being achievable. Is this achievable based on my income right now and my budget? Am I setting an achievable goal, or am I being realistic, or am I being unrealistic? Okay. And that comes to the next one, realistic. All right. You don't want to be unreasonable in the goals you set. Like, I want to make $100,000 this year. Even though I am a big believer in manifestation and speak it, and if you speak it into existence, it will be. But you want to do it in a strategic way. Set that goal, speak it into existence to be. But all right, now let's make a realistic plan behind achieving that. Now, okay, let's not just throw it out there and hope that the wind blows it our way. Okay. And then last thing, time bound. When do you need the money? Do you need this investment money in the next year? Are you going to need to withdraw it in the next 2 years? Do you foresee yourself being able to hold this money in this account for the next 10 years? When do you need this money by? When do you feel like you're going to be ready to start taking off some profit out of this investment that you're making? All right. And now you want to match your risk to those goals. So we have the goals, we understand risk tolerance now, and now we want to match those two together. We want to say, all right, based on my risk tolerance and the goals I have set, what is this picture looking like now? All right. So this emergency fund, it's going to be a very low amount of capital. It's going to be something that is going to be in a high yield savings account or a short-term bond account, something that is maybe a bond that you're flipping on a weekly basis. There are bonds that you get weekly that give you short interest, small interest, so you're going to be collecting somewhere around less than 1% interest on this bond, but it allows your money to still be liquid. It's quickly accessible if you need to take it out, okay? And then you have high yield savings accounts. Those are everywhere. You see commercials for those. Bank of America, Chase. Everybody has a high yield savings account where you could just hold your money, but it's not just sitting there still. It has some kind of interest growing on it. The key is always to have your money working, whether it's working a little or working a lot, or it's working in a risky job or it's working in a safe job. You always want to keep the money working. So that's how you're going to manage that short-term, that emergency fund money. Your short-term money is going to be pretty low amount of capital. You're going to put that into CDs, treasury bills, bonds, and ETFs. All right, that's going to be pretty low risk. Okay, that's going to be like that money is really not going to have any risk to it. It's going to have better growth than the emergency fund money, because emergency fund money is really just to have quick access to the liquid. But the short-term investment money is something that you want to be able to have access to if you need to, but it's not going to be that risky. It's going to be CDs, treasury bills, like I said, bonds, and ETFs. When we already talked about ETFs, a lot of you starting off are going to start off with ETFs. So this is kind of the category you're going to fall in to begin with. Those are the kind of investment assets you want to start looking at when you just start off investing, until you start learning more about the riskier asset classes like crypto and stuff like that. Then medium term goals, you want to have like a moderate portfolio to help you reach those medium term goals, okay? Because you have more time on it. So remember the thing we said about time. These things are correlating the risk to the time. So if you have a short amount of time, you want to keep the risk low, because you don't want to have high risk on the money that you're going to need in a short period of time. You don't want to have that money at risk. You want that money to be there when you need it. All right. So medium term, you could have a little more risk in your medium term investments. These are investments you don't plan to touch for 3 to 5 years. This is kind of the class I try to get everybody to start in when they start investing, to understand that, you don't want to be looking at this as a type of money that you're ready to draw on at any given emergency. This is like last resort scenario. If anything happens, like worst case scenario happens, you go into your investment money. But this is going to be mixed between index funds and blue chip stocks. Still pretty safe. Not crazy risky, but that's more risky than CDs and treasury bills. But you also have higher potential for return there. All right. Let's move on. So now for your long-term money, you could be much riskier. Like those 10 years, things that you're going to hold for at least 5 to 10 years, you could have higher risk on those. That's when you could get into crypto like Bitcoin. You could get into companies like Apple, Google, Nvidia. These are companies that may have a lot of volatility in the short term, but in that 10-year span, they're going to see massive amounts of growth because of the type of company they are. All right, or the type of asset it is, or real estate, because real estate is also another really good one. We see how these house prices are going up and how expensive houses are becoming. So in the next 10 years, it's not going to get cheaper; it's going to get more expensive. So that's one of those long-term investments that you can make, because it's not only about stocks and bonds. Even though that's my main focus, there's a lot more investment classes out there where you can make a lot of money. All right. So we're going to build the basic investment portfolio. What do you need to ask yourself? What are some questions you need to ask yourself, do you think, when you're building an investment portfolio? Let's type it in the chat. Let me see. Let's see who we got in here. Stan, my guy Stan, Charles, Caribbean Vegan. What's going on? Talk to me, y'all. What questions should you ask yourself when you're building an investor profile? All right, we're gonna go is, what am I investing for? All right, that's a foundational question right there. What are you investing for? Is it for college savings? Is it for a house? Is it to build wealth? Is it to have assets that you could borrow against? Is it to double your money? Like I hear a lot of people say when they first get in the market, what are you investing for? Then you're going to ask yourself, when will I need the money? That's the second question I want you to ask yourself. When will I need the money? Is it next month, next year, or 10 years from now? Okay. How would I feel if the market dropped 20% tomorrow? So this is going to let you know, if I put $10,000 in the market right now, if tomorrow it was $8,000, how would I feel about that? Would I be like, oh man, I need to take my money out. I can't believe I just lost $2,000. Oh man, I put $1,000 in there. Oh, I can't believe I just lost $200. If you're going to feel that way and feel like you want to take your money out because of that immediate loss, then you may be too high of a risk profile for you. You may want to lower the amount of your initial investment if that's going to make you feel that way. Okay? Because that can happen in the stock market. And it just happened this year. More like a 15% drop, but it was pretty crucial. Am I comfortable researching and adjusting my strategy over time? This is a big one, because a lot of people want their portfolio to be on cruise control and autopilot. Now that happens if you have a fund managing the money for you, but that comes with certain early withdrawal fees and kind of penalties and all that kind of stuff that comes with having someone else manage your money for you. But when you're managing your own money, you have to have some time, at least quarterly, monthly, if not quarterly, to research the companies that you're invested in, reading up on some news on them, some news articles, looking at their earnings report, seeing if they beat their earnings or if they missed their earnings at least. And are you willing to adjust your strategy based off of looking at those certain points? You could find certain pinpoints that you want to research, and you research those every quarter, and you adjust based on those. But you got to have something that you look at. You can't just have your money in there and like, oh, well, this is this, and I know it goes up all the time, so I'm just going to leave my money in there. I don't need to research anything. No, it's not how the market works. There's a lot of rotations of top companies falling down and lower companies, newer companies coming over and taking over those top positions. And if you're not in the loop, you'll just be lost in the sauce. All right. So, key takeaways today. I want to tell you your risk tolerance and financial goals should always guide your investment choices. Not a gut feeling, not, oh, my boy told me about this stock. Not, oh man, I see this opportunity where I could turn $1,000 into $2,000, even though I know I could potentially lose this $1,000 and it will kill me and I won't be able to pay my rent if I lose it. We're not here to gamble. We're not doing that. All right. So your risk tolerance and financial goals should always guide your investment choices. If that $1,000 that you have invested is supposed to go towards a certain fund or a plan that you had set, keep it for that plan. Do not adjust or change course just for the sake of changing course or because you feel like this situation is now going to supersede this. Always look for every other resource before you tap into your long and medium term investments. Okay, that's why we had the emergency fund supposed to be set up, and that's why you're supposed to have those short term investments set up. Those are the two things you tap into first, and if you can't satisfy what you have to satisfy with those two things and you absolutely have to, well, okay, that's why the money's there, right? That's why it's invested. But let's try to avoid that at all costs, all right? Now we're going to say there's no one size fits all strategy for everyone, all right? It varies based on age, mindset, and timeline. So when people come and they say, oh, what should I invest in? People like to ask that question when they see me out somewhere. Oh, hey man, what should I invest in? What stock should I invest in? And it's like, I would have to take a glance at them. I would have to see, okay, this guy looks about this age. All right. And it's just a guessing game. Unless I sit down and have you do a one-on-one consultation with me and I'm having you answer my questionnaire and I sit there and I go over what you have invested now or what kind of capital you have available, it's not going to be an accurate suggestion. So I could just say go invest in the S&P 500. And that's what a lot of people will throw at you. They'll throw ETFs at you or they'll throw a big blue chip company at you. Because in base case scenario, that is probably the safest bet for anyone that's going to be investing. But that may not be the best thing for your risk profile and for your objectives and your goals. So, and S&P 500 may be okay, but you may sit there and be like, oh man, I'm not really making the money I need to make on this. I was expecting to do this. But that goal wasn't expressed. That goal wasn't have a strategy built around it. So now you got an ETF suggestion and recommendation, which is why I suggest if you want to invest, you could learn a lot of things through these channels and people teaching online and all this. But you got to invest in yourself. And if that means getting a consultation and paying for something like that, if you're not knowledgeable yourself and not an expert yourself, pay for someone who has the expert knowledge to help guide you. That's an investment in itself. People don't look at it that way, but it's an investment in itself, in yourself. So now you have some kind of guiding hand to help you set up a foundation that saves you so much time and energy and effort that it pays for itself 10 times over. All right? So building the plan now makes every future investment decision easier and more focused. So the sooner you start planning your investment goals, as soon as you start getting this emergency fund set up, it makes the next step easier, and you're able to focus on it more. So emergency fund is done. Now I can focus on getting my short-term investment portfolio set up. All right, let me get $1,000 into there. Okay, now I got that set up. Boom. Next thing you know, it's already 6 months past, and you already got these two funds set up. instead of sitting here trying to do everything all at once and you're not getting anything done at the end of the day because you're drawing on all the money and you're not getting the emergency fund set up because you're trying to set up long-term investments at the same time and you're doing this and that. Just do it strategically and set a path for yourself to follow, okay? And always, if you need to, you reach out to me. You follow Culture Shock Investments on all platforms. I have the Discord community where I do most of my one-on-one teaching and group teaching. You'll catch me here on TikTok with some posts and live sessions every Sunday night at 7 o'clock. I do the class, and then 8 o'clock, 8:15, I do my charting session. Yeah, 8:15, I do the charting session where we're going to chart the stock price levels for the week with the people who already have some of these funds set up. And if they don't, I always get on them about why are you doing this if you don't have these funds set up, okay? So, like I said, you can follow us on YouTube, TikTok, Discord, and you're already here on TikTok. Make sure you share the page, and thank you for joining the live class tonight. If you have any questions, feel free to DM me your questions. Make sure you like the space. Like I said, share it out. We want to get this algorithm out to the black community. We need more of this on our timelines, educating and helping uplift the black community in understanding financial literacy. This is one of the main keys for us to elevate ourselves on a global scale. And I see it happening more and more, and I'm happy for that. So let's keep it going and keep the mission alive and keep the momentum going. All right. So I will see you all next week Sunday, and if you're gonna do the charting session, I'll see you at 8:15. And let's get this money, y'all. I'm ready for this week. I'm excited.